So, welcome again. Yeah? I'm Maria Doicu, and I would like I will just introduce you the working group members and the concept of the working group. So, European Microfinance Network is the network of microfinance institutions in the European Union. So, one of the activities of the European Microfinance Network is to involve the members, to support the members in various aspects of their activity. So one of the working group is the Legal and Regulatory Environment Working Group, where the members of European Microfinance Network from the countries where this legal framework exists are supporting the members from the European countries where this legal framework doesn't exist or it's in process to be established. So, microfinance legislation in Europe. We would like to present you how the legal and regulatory framework can advance, can support, or can hinder, can work against the microfinance sector in Europe. But from the beginning, you have to be aware what exists. So what type of legal framework for microfinance institutions, for microfinance sectors, which are regulating the sector, exist in Europe? And the presentation is actually split in two parts. The Eastern and Central European, let's call them model, and the Western European model. Why? We discussed in the morning that the legal culture differs from the Eastern European to the Western European side. Yes? So if in Eastern Europe you need a legal framework which allows you to do microfinance, in Western Europe, if you don't have a specific legislation which forbids you to develop that activity, you can do it. You don't need a specific primary legislation to do microfinance. It's allowed. It's an economic activity. It's a financial activity. So it's allowed if there is no a specific regulation which forbids you to do that. That's the legal framework in UK. That's more or less the legal framework in all the other, in Sweden. That's the legal framework in Germany. That's the legal framework in the Nordic countries. No? It's allowed, you know. You don't need a specific legislation. But in Eastern Europe, you have to be somehow regulated and covered by a legal framework in order to be able to do it. So we will present Romania case study in detail after. Right now, I will hand over to my colleague from Hungary.
Okay. So first and foremost, it is important to mention that there is no general legal framework regarding the microcrediting sector in Hungary. However, there are special rules in force which regulate the operation of institutions that deal with microcrediting. And in order to understand these regulations, it is inevitable to learn about the history of microcrediting. After the political changes, the number of micro and small enterprises started to increase rapidly at the beginning of the 90s. Why is that? Due to the fact that a lot of people who had been made redundant as a result of the closing down of factories, they were forced to set up their own enterprises. Since after the changeover from the controlled plan-type economic model to market economy, these enterprises had to form the backbone of the national economy. The Hungarian government that came into power after the changes aimed at strengthening this sector. A group of developed industrial countries made a decision for the first time in 1989 to support the process of economic and political transformation in the former socialist countries of Central and Eastern Europe. The FAR program was started in 1999 in Poland and in Hungary. It was an aid program for economic transformation of Poland and Hungary. And the government of the Hungarian Republic worked out an entrepreneurship promotion program. As an important element of this, they initiated the establishment of an agency aiming at supporting motivating the enterprises. The Hungarian Foundation for Enterprise Promotion in 1990, with a starting capital of 4.24 billion Hungarian forint, approximately 14 million euros. Since the objectives of the FAR program launched in Hungary and the objective of the Hungarian Foundation for Enterprise Promotion were the same, the HFEP was entrusted with the handling of the aid program of 21 million EKU reserved for the development of small and medium-sized enterprises. FAR required the setting up of a local enterprise agencies LEAs network, where the target group was supported in the form of professional counseling and business services. The concept of launching the national microcredit scheme was formulated at the beginning of 1992. So let me introduce the organizational and operating structure of FAR microcredit program. There's a question mark here, who's the odd one out in the structure. The European Community and the Hungarian government granted the donation to the Hungarian Foundation for Enterprise Promotion, whose responsibilities are liaising with the donors, source allocation, providing technical assistance for the LEAs, professional evaluation of the program, checking program implementation, mediating the sources to the LEAs in the form of earmarked subsidies. The responsibilities of the local enterprise agencies are receiving loan applications, assessing and approving of loan applications, checking loans, and risk management. The accounts of the LEAs were managed by the bank that were also responsible for keeping the separate program account of the local enterprise agency, concluding the loan agreements with the clients on the basis of the decision of the LEA, disbursing the loan from the bank account of the LEA, collecting installments, keeping loan accounts, credit records separately from their own loan portfolio, and supplying LEAs with data with regard to the loan portfolio. So you can see that the odd one out in this system is the bank. When the microcredit program was launched in 1992, the operation of profit-oriented financial organizations was regulated by Act on Financial Institutions. The basic function of the Act was to protect depositors and to regulate the operation of profit-oriented players of the money market. Several experts believed that commercial banks should be included in the operation of the program because according to the above-mentioned Act, only banks may grant loans in Hungary. Commercial banks only perform technical tasks in the process, and they did not assume any risks. Why should not the Act on Credit Institutions apply to the LEAs? Since the non-profit foundations involved in the operation did not deal with deposit taking, perform their activities as non-profit organizations, they did not make any profit, and received the sources, public money, in the form of earmarked subsidy in order to grant loans in the field of money market requiring government intervention to fulfill specific social goals. Government intervention in this case is justified by the following principle of economics. Market failures, a situation when government intervention is required in order to maintain undisturbed operation. Incomplete markets are a type of market failure because the quantity of a product demanded by consumers does not equate the quantity supplied by suppliers, and certain capital markets can also behave in this manner. During the operation of the program, it was always debated whether it was justified by the applicable act to involve commercial banks in the program. The solution seemed to be obvious. If it is not clear that the Act on Credit Institution does not apply to the operation of the microcredit program, this fact has to be made clear. The amendment of the Act on Credit Institutions resulted that the microcrediting activity of local enterprise agencies was removed from under the effect of the Act. The amendment was introduced in 2003. The consequences were the following. It became possible to launch alternative microcredit programs. Local microcredit programs were launched, and the majority of LEAs could join the Jeremy program. The number of non-profit microfinance organizations did not increase in Hungary, which shows that this is really not a legislating issue, but rather a question of interest in Hungary. So which were the obstacles hindering the spread of microcredit programs fulfilling social purposes in Hungary? Limitations of the economic and social environment, financial constraints, sustainability requirements, and constraints of the individual players. And what are the rules relating to the establishment of a microfinance organization in Hungary? Its operation is regulated by Act number 112 of 1996 on credit institutions and financial enterprises. The regulation concerning its legal status is the Act number 4 of 2006 on business associations. Its official name, financial enterprise. It may be established with a startup capital of 50 million Hungarian forints. Its legal form, either public or a private limited company. It is profit-orientated, though it may choose to operate in a non-profit manner too. It may not take deposits, and simpler rules apply to them than to the banks. And in the case of profit-oriented institutions, the above-mentioned external rules determine the internal regulations. Speaking of accounting rules, money handling policies, general terms and conditions of business. The internal regulation of LEAs are very similar to this, but there is no external regulation or act defining it. So what are the internal regulations of LEAs to be able to join the Jeremy program? Accounting rules, bylaws, crediting regulations listed above, data protection and management regulation, quality assurance regulation, and social strategy. Thank you.
So, thank you very much. That's the legal framework for microfinance programs and microfinance providers in Hungary and how it evolved. I will present information related to the France, Italy, Germany, and I will ask my colleagues from Spain and from Sweden to present the legal framework from their own countries. So, how is microfinance regulated in France? There is secondary legislation, so which contains specific rules related to the microcredit provision, establishment and operation supervision of non-bank financial institutions not for profit. The main microfinance institution in France is ADI. So ADI was the initiator of the legal framework transformation in France. And they succeed to open a door through a very strong lobby effort, open the door to the banking sector, which allows them initially to provide services for the banks, taking the risk and allowing them to extend microcredits to beneficiaries which were in that time not bankable yet. So this was the initial step. After that, they open larger the door, and right now they can establish microfinance institutions which can extend directly the loans. There is one issue you have to be aware of. So the clients are clients of the microfinance institutions in France for the first 2 or 3 cycles. Afterwards, they grow enough and they become bankable and they are transferred to the banks. Yes? Usually the market, they assess the market together with the banks. They are serving the non-bankable, which are provided by the banks, transferred by the banks. And there is a mix of financial and non-financial services, which is provided by the microfinance institution in France. It allows to the sector to grow. It's not only ADI anymore. There are other microfinance institutions, but ADI is still the largest one, the largest microfinance institution in France. So they don't have a primary legislation, they have a secondary legislation, which allows the sector to grow. Italy. So it's very new. The legal framework is very new in Italy. So was promoted in 2010 and allows the creation of non-bank financial institutions as non-profit, non-bank financial institutions. There are some limitations. So we agreed all that the lobby for the improvement of the legal framework never stops. So they already find out some imperfection, and they will plan to adjust it. Actually, they cannot extend online loans. They cannot use the electronic environment for extension of the loans. Only physical loans can be extended temporarily. Yes? Germany. Germany recognized the importance of the microcredit, but they don't want to undermine the monopoly of the banks. So how they are how microfinance works in Germany? There are the banks. They have the monopoly of extending the loans, and there are the microfinance institutions which are taking the risk and are working with the clients to apply, to develop their business plan, apply, and monitoring the client. And of course, they are covering the default. But this is a scheme which was the initial French scheme, but it's heavily subsidized. Germany is a state which can afford to subsidize the entire sector. They can do it. Yeah? So it's mainly an issue of resources, and the banking sector is contributing with the resources, adding to the resources provided by the government to fully subsidize the microfinance. Okay, Germany. Spain.
Okay.
Hi.
Well, let me explain you a little bit. Spain for many years has been one of the countries in Europe who has been delivering a lot of microcredits. But there was a problem. The monopoly, as Maria said, was on the hand of the saving banks. It shouldn't be a problem, but there was a problem. Saving banks, as any bank, don't want to take risks. So, and they are far away from the most needed people, because saving banks are in an office. They are not working with the minorities. They are not working with vulnerable women. You know, so to reach these people, they engage social entities. So social entities were doing the intermediation. They were doing the training, the follow-up, and everything. But the final decision was in the saving bank. And the saving bank finally decided that the most needed people were not their clients, their profile clients. So they wanted to, I mean, the bank is risk avoiding. You know, it's the philosophy. So if they have to choose between someone who has less risk and one who has a lot of risk, they will take the less risk. So that's what happened. So the diagnosis was that in Spain, microfinance was not reaching the most needed people. There was a big gap there. This gap was even worse when the financial crisis made that all the saving banks stopped their microcredit programs. What happened? As they were the only ones, the microcredit system collapsed in Spain. You know, so from this point, starting point, we have a meeting with all the sector, saving banks, associations, foundations, women associations, migrant associations, a lot of stakeholders, more than 120, even regulators, saving banks included, and we make a SWOT analysis. We define what were the weaknesses of the former system. We wanted to know what were the opportunities to create a new system. And one main issue who was as a weakness, as a threat, and also as an opportunity, was the regulatory environment. There was no microfinance regulation in Spain, so only financial institutions can provide loans. So everyone agreed that we need the figure of microfinance institutions. Institutions who are non-profit, who are social orientated, and who are doing a very important work in Spain now. Because in Spain now we need that everyone start working, not receiving subsidies. You know, so from this starting point, we have been working for 2 years in coordination with the European Microfinance Network, are learning from all our colleagues what kind of legislation we need in Spain. And finally, we come up with the results. There are only 7 points. We're not doing a full regulation. Only 7 points that I will summarize. The first one is that we allow to the social entities to develop, to give loans. The second, these social entities could have credits, loans from the commercial banks to their job. They could receive funds from the European Union, European Social Fund, European Investment Fund, and everything. Can be also supported by the regional governments, as is done in France, and they are non-profit, and they have to have 2 kinds of audits: financial audit and social audit. We need to know that these social entities are doing their job. They are working with the most needed people, helping them, in order that one day they can go to the bank. You know, that was very important what we did in Spain. We involve the banks in this process to make them understand that we are not competing. We are helping them because we are working with the non-financial inclusive people and help them to be included in the future. You know, so that was the whole process, and we arrived to that point. Very important is that you need to involve all the stakeholders. You need to have not your position. You need to have the position of the sector, and that's very important. That's how we are working now in Spain. Thank you.
Thank you, Jaime. So Sweden, your experience in microfinance, please.
Just to understand our experience, I have to go back some few years ago and explain how the whole thing started. NEM is an NGO that basically works with the migrant women, and during that time we did notice that there's a gap for women entrepreneurs who want to start businesses to get this from the banks. But just to do that, we thought of the best thing is to start with the project and see how it is. So we had European Union funding to start the project, and that we did in almost 3 years. And during this time, what we did is we did all the business development services to the women, and then you take, when the person is ready, you go to the banks with them and say, okay, we're done, and can you give microloans to them? We noticed during this time that it was really difficult for the banks to do that. One was that they say a microloan for 25,000 euro is too little for us to do the administration on it, and it takes a lot of time. So the banks were reluctant still to give out the money. That's when we decided, okay, why not set up a microfinance institute in Sweden? The problem in Sweden is you're allowed to set up a financial institute. There's no law or regulation that says you cannot put up a microfinance institute. But at the same time, for the Swedish government to accept that there is a microfinance institute was like you're accepting this poverty in Sweden. Sweden is a developed country. So most of them were like, no, this is because microfinance is for Africa, Latin America, and all that. So for us, it was just to get the legitimation that microfinance is something that is needed for the community. It has 2 sides on it, the microfinance in Sweden. One is to get these women financially independent, empowering of the women, and at the same time, it's like you're getting the social inclusion for them. People who do not have, women who are not bankable, women who can never, they don't have a credit history. You move into another country, you do not have your relatives with you. You don't have anybody who can say, yeah, I know this woman and she can pay it back. So it was really important for us to do it. The migrant women went together. We set up a microfinance institute. We got a special permit from the financial inspection, because it's not the central bank that gives it in Sweden. The financial inspection is under the central bank, but they're a public authority that just gives us the permit. So we got a special permit, but mostly it's just because of the work of, we had a minister in, for enterprises. She was really involved in that, and so that we got a permit to do it. So with that permit, we can basically, Microfinance Institute is a company now on its own. NEM does the business development service, and we provide microloans from the Microfinance Institute.